Just wanted to preview my retail sector ahead of FY17 reporting season. I would refer you to that report we published last week with all our detailed expectations. But if we start off just looking at the year that was, it was a pretty wild ride, as we've come to expect from the retail sector. But I suppose what you can take away from the last 12 months is perhaps not to panic when the noise is at its loudest, as you can see by this chart. If you look at the biggest D-rate in October, November period, that was when the Amazon noise was starting to come out, but it was exacerbated by the fact that there was that big out of small cap into large cap rotation at play, plus a couple of mandate losses in institutional land. The sector then recovered before derating again. This derating, in my view, was more about the consumer, the state of the consumer, weak consumer spending, etc., but also Amazon noise again. And then in late April, Amazon confirmed its entry, a little bit of a derate, and then a few downgrades we saw come into May. You can see by the chart here, we're trading on around 13.4 times PE. The 3-year historical PE average is around 15 times. So more than one standard deviation below at the moment, but we're also in a very different environment, and we've got some escalating competition headwinds. So that 13.4 times, it doesn't, it could be about right. But what we need to remember in here is that in consumer discretionary, you also have a lot of travel stocks and not just retailers in there that are trading on 20 to 30 times. So implicit in that number is a lot of retailers trading on 11 times and below. So still some opportunities out there. Just in terms of the key themes we're looking for, I've said to you a few weeks ago, we don't believe the consumer got any worse post-May. If anything, actually conditions probably improved a little bit into May and June. This coupled with the fact that around 85% of our coverage universe has either provided a formal trading update or provided formal guidance in the last two months, means that we see less earnings miss risk this season than we've seen for some time, and perhaps more retailers capable of hitting the market's expectations and what the market's factoring in. So against this, we don't see a lot of noise around the actual FY17 results, which means that 6 or 7 week trading up into first half trading update into first half 18 is going to be critical, as is any kind of formal guidance or outlook commentary. And in this regard, I would just note that a lot of retailers are actually cycling quite a high base in the start of FY18, because that's when a lot of people put through price increases to help offset that lower Aussie dollar COGS kind of pressure. In terms of key thematic commentary, we're looking for some GM compression. A lot of talk about the higher Aussie dollar. These retailers would be locking in, their hedging positions, hammer and tong at the moment. The average kind of hedge rate in last year was around 72 cents. I mean, if that's anywhere like, 76, 77 cents into FY18, that provides a nice little GM buffer into next year. We should see some first signs of some rental cost savings or rental reprieve. Maybe talk about some store rollout slowdown and probably a slew of Amazon defense strategies. But I would just say expectations for the sector are low, short interest is high, and Amazon continues to dominate the press. So just in terms of a bit of a reporting season roadmap, where we think companies can beat either their guidance or, more importantly, consensus. Firstly, Lovisa. Secondly, Bapcor, JB Hi-Fi and Apollo. I'll go through some of them in more detail in a tick. Potential for an earnings miss, Beacon. We think that can hit our number, but we are below consensus, so some risk there. I should also mention Domino's. I'm a little bit concerned about some of the trends that may be implicit in their actual result. Low expectations, we're simply hitting the street, may see a re-rate. We've highlighted Baby Bunting and RCG there, although I would use any strength in RCG to exit that name. Potential positive trading updates, we've highlighted Lovisa, Motorcycle Holdings there. So just moving on to our top picks at the moment, and we do remain kind of fleet of foot as always in this sector, and the ones we're avoiding. High conviction, we're with Lovisa, Bapcor, Motorcycle Holdings at the moment. Also very positive on Apollo. It's not a strictly speaking a retailer, but very positive on the outlook there. We're negative or bearish on RCG. Would be using any strength to exit that name. There's a lot of retailers in there that are kind of neutral fair value, but there's every bit of the word a hold, like AP Eagers, Baby Buntings, Michael Hills, etc. So just looking in more detail at the stocks we're liking at the moment. Firstly, Lovisa. it has done pretty well over the last 3 months. It upgraded 2 months ago. Implicit in that upgrade was that like-for-like sales would slow quite dramatically into the fourth quarter. We've actually done a little bit of, a fair bit of work around back solving all the like-for-likes they've given us over the last year. And we strip out that their April number was actually a lot stronger than we thought, like a double-digit like-for-like sales number. Now, this is when they're actually already cycling a very strong base, a double-digit base, plus they were cycling the exit of a key competitor. So that gives us confidence that if they're already cycling that with a good number, that should it'll give them a good exit rate and enable them to do that in first half 18. And that's what the market's a bit concerned about, how they cycle such a strong base the first half of next year. We're seeing pretty broad-based strength across their categories. I mean, statement earrings are a big thing at the moment, not necessarily my cup of tea, but they're everywhere. But look, there's broad-based strength in this cosmetic, affordable jewelry category. I expect they will reiterate that Spain is their next territory. You can see them advertising for managers, etc., in their new Madrid store, so expect them to confirm that. Just a reminder here, this is the quickest store payback model of any retailer we cover. This is like a 3, max 6 month kind of payback store model. They've already invested the overhead in Europe via the UK. So once Analyst can put some new territories in this in Europe through their numbers, DCF suddenly start gapping up, as does earnings growth. So we're still maintaining the rage on Lovisa there. Bapcor, we've spoken about this quite a lot. It was good to see the synergy targets given to the market last week, allowed a few EPS upgrades. What they did drop in the call, and it was a good reminder, we'd all forgotten about this, was there's also a whole other piece here around their warehousing duplication. So when they bought Metcash's business, they had around 16 warehouses between Bapcor and A&A. They haven't done a thing with that. So they're saying at this upcoming result in August, they're going to talk to the market after doing 12 months of work about the potential efficiency prize that will now come from that. So that's another piece we can keep our eye on. The result itself, the market's sitting at the midpoint of the range. Darryl left the call saying he'll deliver his result in August with a big smile on his face. So expect, as their track record is, that they could deliver at the top end. That'd be a 4% beat. That's handy. So you can kind of see a range of reasons why we always have to incrementally upgrade our forecasts. The last piece of the puzzle here is just selling these assets. And, it's an inherently difficult game selling assets when you've got a mix of vendors who aren't necessarily in a rush. But we still maintain that they will sell these, hopefully at least 60 mil of the 110 in the next couple of weeks. So, it's trading on 17 times. We've got another 25% growth coming next year, a 3% yield, still strong organic growth humming in the background. So it's rallied a bit, but happy to buy this one or accumulate this one on weakness. Motorcycle holdings, probably a fair kind of multiple for this kind of business, but we're always going to be chasing our tail with this one in terms of the valuation. So when I look at this stock, the result, I think it'll just hit our numbers. It will show, though, just how much they've outperformed the new motorcycle sales market when you look into it. There will be some headwinds in terms of costs from the acquisitions they've made, which will turn into a tailwind next year. We're forecasting 17% growth next year, largely from those acquisitions. But how I look at this stock really is as a consolidator. It has a beautiful, fragmented industry. No one else, rolling it up. They're on their own here, and a CEO that's been doing it for 30 years. So it won't just be in dealerships they're acquiring either. Dave's been, talking at conferences, etc., saying, we really want to go down the channel. We want to get further into accessories, etc. So, I'm looking this as a multi-year, not a 10, 20% return stock, but as a really good performer for our network over a couple of years, this stock. So that remains on my high conviction list. Some other stocks to watch I wanted to focus on. ATL, they recently upgraded their prospectus forecast by 5 to 10%. We're sitting at a 6.5% beef versus prospectus. There's every chance they come in right at the top end of that range. So I'm very, very comfortable with that one. Forecasting another 18% growth into next year and trading on 13.2 times and a 4% yield. That's a really solid place to be. Beacon Lighting, we've been high conviction on this one, and it has hurt us over the last kind of 5 to 6 months. We're very comfortable with our forecast, but as I said, it may miss the street slightly. But I think the reason for that if the company clearly articulates all the pre-opening store costs in a record year of store rollouts, the market will go, oh, maybe that's not so bad. So it'll also turn into a nice tailwind next year. So happy just to really wait, stare that result in the face, and then have a more convicted view there. Super Retail Group, some really good updates in recent weeks. I'm very comfortable there too. 11.6 times PE and a 6% fully franked yield. I think that's a pretty good place to be. They're well ahead of the curve in terms of their peers and getting in the front foot against Amazon. A really impressive change of strategy with sports there, so happy. JB Hi-Fi, it's one that's been well held by the network. Again, I expect to beat, but what I'm worried about is their trading update, because they're cycling a 9.5% comp base. In fact, for the whole rest of the FY18, they're cycling a pretty strong base. So that, coupled with the fact that Amazon is a clear headwind for this stock, I think keeps a lid on it, unfortunately. However, the risk to the upside is that Richard Murray comes out and massively upgrades those good guys synergies over the next few years there. So preferring to steer clear there. So just in terms of a summary, I suppose, expectations are low, short interest is high. I think more companies will meet the market than what the market's perhaps expecting, so less earnings miss risk. Amazon isn't going away. Hearing some noise there. It could be late this calendar year, operational next year. It will only be marketplace in the start. It won't be, prime straight away, so it won't have a big impact. In fact, a lot of these retailers will just sell via marketplace in the first year or two. But look, it's a tough sector, but there are opportunities. And I must say, when you look at my coverage and you probably say, why don't we have more sells? It's because we don't cover a lot of apparel retailers or really kind of bulge bracket retailers. We cover a lot of specialty kind of situation retailers, and that's where we'd prefer to be. So again, key picks, Bapcor, Lovisa, Motos, and also very comfortable with Apollo and Super Retail Group.